So I guess, yeah, as interest rates continue to be maintained for a longer period, putting our commercial property owner hat on, your thoughts around the commercial property market and businesses in this low interest rate environment as to whether they're in an expansionary mode. Clearly at the moment it's very much watch and wait and see. What's your sense of commercial property market and some of the things as an industry we should be looking at for in this low interest rate world?
Oh, so if I look at the commercial sector, and let's acknowledge what's going on. It's challenging economic times.
Yeah.
But generally in regard to the commercial property market, you've got two risks. Your risk one is interest rate risk. And particularly when we see what's called cap rates get down close to the levels at which the cost of capital is. When we start to see that sort of compression, it's a sign that there's not enough credit risk built into the system. Yeah, what do we know at the moment? Yeah, cap rates are actually still pretty juicy relative to the cost of capital. Yeah, so you actually don't see too much of a material mispricing within the sector in regard to people who've been getting a little bit too gung-ho in regard to where those cap rates actually are. There's some isolated examples of that, but it's not across the board across New Zealand. And what we know at the moment is that the Reserve Bank is not moving interest rates for an awful long time. Yes, so interest rate risk is a threat to the commercial property market. We can basically park that one. Okay? It's not the threat it was in 08, 09, 97, 98, these previous interest rate cycles. What we also need to acknowledge is that the real big threat out there for the commercial property market at the moment is just the economy and what is going on. And of course, we're now lockdown level 2. We've still got to wear the cost of shutdown, border control, less migration, fewer tourists. So some sectors are still going to see a fair bit of pain. But I think it's morphing towards it's somewhere between a W-shaped cycle and a K. So a W-shaped cycle is obviously, we got hit pretty hard during alert level 1. There's alert level 2, but the shutdown. So we're going to be wobbly, I think, here for a while. But of course, I think there's going to be elements of what's called a K-shaped cycle here as well. And the K-shaped cycle is, look, you want to be on the top half of the K. That's when you sort of kick back up. But of course, what we know is that some sectors are on the bottom half of the K. So what I think is increasingly relevant here for commercial property owners is due diligence. Looking at your tenants, making sure they're up for the play in regard to what's called the sort of new economy, adjusting, evolving their business plans, because there is no new normal. Things are moving sort of step by step. So we just need to acknowledge that tenant risk is going to be there, and we're going to see vacancy rates move. But of course, we see, I think, a tightening in supply as well, because the cranes are going to come down, because people are not going to be building the stuff. And we're going to see fragmentation. We're going to see industrial, I think, outperform retail. But we've known about the retail story for a long time. But even within retailing, I think you're going to see good retailing and bad retailing. We've got to be really careful about one size fits all, but we do need to be realistic in regard to it is very challenging times over the next sort of 12 months. But out of this, there can be a hell of a lot of opportunities as well.
Yeah, I totally agree. And I guess we've spent probably the last 5 or 6 years thinking about the next economic downturn, i.e. where we are now, and repositioning a lot of our portfolios, particularly buildings and or tenants that we have deemed to might be a little bit more exposed to the economic headwinds, proactively recycling those buildings and tenants out of the portfolio and recycling that capital in what I call more resilient buildings and tenants, whether it's exposed to essential services, government agencies, and higher quality newer buildings, essentially, that are more resilient to fundamentally tomorrow's market. So you're quite right. The interest rate risk for us is fairly low. It has certainly had its benefits as a funds manager in the sense of offsetting some potential risk or costs associated with, for example, lockdown level 4 and rent rebate by a small impact to income, but also in the sense of vacancy risk. And we are, as you talked about earlier, in a tough economic environment. We will see businesses downsizing over a period of time, and so we need to adapt our business model to ensure that we're more proactive around that in the way we position our real estate and offering to the market. So that's quite apt, really. Interested in your views, and I guess we don't want to dabble into the sort of the financial advisory space here, but obviously on the investment or investor side of the ledger there, they're facing into an environment where they've got money on term deposit and clearly receiving fairly little in the sense of returns on term deposits. What does the world look like for them in the coming sort of months and years ahead if we're in this lower for longer, I guess, environment?
In a word, tough.
Yeah.
Yeah, central banks at the moment, we can sort of debate or argue here about whether central banks are actually doing too much to protect the economy and protect the zombie firms. Because of course, when you take interest rates down to record low levels, who are you supporting? Well, you're supporting the borrowers and you're penalising the savers on the other side. And sometimes you wonder about whether they're actually doing too much. And of course, what we're seeing at the moment is that we've got a bit of a separation here between what's called Wall Street and Main Street. If you look at the Wall Street indicators, equities or the housing market, boom, we've sort of kicked back up. But if you look at the Main Street indicators, the unemployment rate, that's the bottom half of the K. It's still, it doesn't look that great in regard to what the trajectory is. So there's, the central banks, I think, need to be pretty careful here in regard to how much of a lever they actually pull. Look, ideally, what we need across globally and in New Zealand at the moment is that the monetary policy needs to be what's called the supporting act. But the lead actor needs to be fiscal policy. And this is where, I think personally, too much of attention has been on, if you look at the COVID response and recovery fund, probably a little bit too much attention on response and not enough on recovery. Obviously, having this later border incursion has been a borderline economic disaster in regard to what the economic cost is going to be. And unfortunately, we're going to see some parts of New Zealand, particularly Auckland, notably in around the CBD, that sort of stuff, they're going to really struggle. The hospitality, retail, it is going to be incredibly tough times. But even out of that, we're seeing some positives. As people are no longer travelling into the CBD to work, what's going on? Suddenly you need the coffee down at the cafe in suburbia. So there's demand for more commercial sort of stuff out in the suburbs. So it's that old sort of adage, for every action, you see a reaction or an opportunity on the other side. So once again, I sort of go back to and increasingly thinking about this K-shaped cycle, opportunities on some legs, but there's some realities on the down legs too.
Yeah, I think I totally agree with you, and I guess that's why it's more important than ever before, particularly as a fund manager with a degree of autonomy to think very carefully around where these trends are going and anticipating some of these trends so we can take advantage and capitalise on those opportunities, as you say, on the upward part of the K, be it industrial and warehousing logistics, which is obviously a very good story at the moment, higher quality office assets, perhaps even some suburban office assets where the work from home phenomenon is now starting to play out. So we see some opportunity in that space, and as an autonomous funds manager, there's an opportunity to continue to add and build robustness and resilience within our portfolios by taking that strategy. Certainly from our clients and the people that we're speaking to on the investor framework, a lower term deposit rates means investors are going to have to work a lot harder to generate the return that they perhaps want to support their other income or retirement. First thing we always suggest is absolutely take good financial advice. Seek independent advice, which might take into account your own personal circumstances and/or goals. But absolutely, there's other alternatives on the shopping list, and we very much firmly believe unlisted commercial real estate provides a degree of security to land and bricks and mortar, but a regular, reliable income stream that has that sort of cash flow element built into it. So a really good opportunity to participate in that as well. Okay, well that's excellent. Thanks, Cameron. So I guess in the sense of New Zealand Inc., it's about summarising where we are going into a lower for longer interest rate environment, lowering that cost of capital through monetary policy, but certainly your emphasis around there's more that needs to be done around the recovery and perhaps the government fiscal plan around that as well. Businesses are no doubt going to benefit through lower cost of capital and hopefully some confidence to continue to invest and support their own growth. The commercial owners in this market, there's opportunity out there. It's about having your eyes open, making sure we're not exposed to, the properties of tomorrow that the market might not necessarily demand because of structural shifts and autonomy around that. And clearly the challenge for investors in a low interest rate environment with cash in the bank, where does one put that? Absolutely seek great investment advice, but certainly unlisted funds, there's an opportunity there to seek some returns and add that as part of your overall portfolio strategy, I guess. So Cameron, really appreciate your time this afternoon. That's been useful. I hope those watching today have gained a bit more, understanding and insight as to what a lower for longer or negative interest rate environment might look like for making some strategic investment decisions moving forward. So Cameron, really appreciate your time as always.
Can I have the last word?
Absolutely,
last couple of words, right? Yeah, I'm not an authorised financial advisor, but I'm going to reinforce something you said there. The only piece of financial advice I'll give to people out there at the moment is, yes, go get some proper financial advice.
Fantastic.
It's absolutely critical in the current environment. The second thing is that, I think what we're going through here at the moment, we're in about round 4 of a 12-round boxing match. And we just need to acknowledge that, we're going to take a couple of uppercuts. But we're going to stick around. I think New Zealand, if I compare us to a lot of other countries around the globe, we're in relatively good shape. Now, by good, that's in a relative sense, because I don't think anybody's in that good a shape. But I think if we're slick and smart, there's going to be some opportunities out of this on the other side. And COVID is just a lightning rod on a whole lot of things that were going to take place anyway. We knew about retailing was going to struggle. We just pulled that forward. So the quicker we embrace it, the quicker we're going to come out the other side too.
Absolutely. I think using that adage as the glass is half full, and as you say, progressing for the opportunity. I think it's exciting times ahead. Very most interesting times. That's for sure. So look forward to I guess the sort of coming weeks and months ahead, and what the environment's going to play out. Very much why we as a long-term investor have a long-term investment framework or timetable. We don't try and pick the ups and downs of cycles. We invest through cycles, and so I think that's really important to finish on really as well. Cameron, really appreciate your time. Have a cracking afternoon, and we'll no doubt catch up with you soon.
All the best and take care.
Thanks, mate.